Tyler, you know I am a bull on UPS. I own shares. I didn't buy it for the high dividend yield. I bought it because the stock is beat down a ton, and I believe that they are going to be able to successfully turn the business around, shrink their more commodity business, and refocus their resources into areas where there's better margin, where they can leverage their footprint and the things that they're good at and actually grow earnings over the long term. You disagree with me. You're the bear. Let's have that discussion.
That's why you bring me on here, is to dump cold water on all your great ideas.
Well, let's have this cup of cold water. I'm Jason. He's Tyler. This is Investing Unscripted. This video is sponsored by The Motley Fool. We get to make these videos because of our partnership with The Motley Fool. And if you're looking for even more great stock ideas, do yourself a favor and go to fool.com/unscripted. You can get access to The Motley Fool's 10 best stocks to buy right now. I encourage you to check out that link. Okay, Tyler, let's eat our veggies first. Let's hear the bear case for UPS.
Okay. Well, here's the simplest one. Stocks can be really beaten down, and a lot of people can look at it and be like, probably right now, staring at the 7.5% dividend yield at UPS and being like, well, even if the dividend gets cut in half, the stock will still be great. Well, last time I checked, no matter when a company cuts its dividend, the stock tends to drop, because there's plenty of people who say that, and they're like, wow, it's 7.5% yield. We can, even at the worst case, I get paid to wait, basically. I think this is a case where you're going to have a company that's going to have to cut its dividend before it is able to facilitate or execute the turnaround that a lot of UPS bulls have been claiming. Just to do a quick back of the napkin here, over the past 12 months, UPS brought in free cash flow. This is before dividends, before buybacks. They brought in about $3.5 billion in free cash flow. That was with a $1 billion asset sale included in there. So with consider that $3.9 billion. Over the past 12 months, UPS has had to spend $5.4 billion on dividends. So we have a $1.5 billion gap between the dividend payout and its free cash flow. So let's assume that the business starts to turn around. It's still deliberately shrinking its Amazon footprint and its e-commerce footprint and kind of that low margin parcel business. It's still there. And it's still shrinking. It's small, medium business, it's healthcare businesses. Yes, those are growing and they're higher margin, but they are considerably smaller. I think this turnaround is going to take a couple of years. I think we're going to see declines in revenue. I think we're going to see declines in profitability. I think we're going to see declines in free cash flow from here. And if that's the case, you cannot be running $1.5 billion deficits just to pay your dividend. It's unsustainable. And it doesn't make good business sense. And so I think over the short term, UPS is going to cut its dividend. And as a result, it's not worth buying the stock until that actually happens.
So Tyler, you bring up some good points, and I'm going to agree with you that I think that there is some risk of the dividend being cut. However, two things can be true at the same time. I think that you're probably wrong about their ability to grow earnings over the long term from some of these other areas. Yeah, the e-commerce last mile market has certainly driven the lion's share of volume of growth in parcel shipments over the past decade. The past 5 years have been enormous in terms of growth there. And obviously the writing was on the wall that Amazon really didn't want to pay FedEx or UPS or anybody to do that last mile. They wanted to bring that in-house and drive that cost down, and then just let the post office do the stuff that was too expensive and too small, right, in areas where the post office has to be anyway. So that's a reality. But at the same time, I think if you look at healthcare, the trends are still incredibly favorable to keep growing there. Their existing network is really valuable in terms of being within 24 hours back and forth of just about anywhere in the US. That's really valuable. There's international opportunity. And then in some last mile, small and medium-sized business, there is an opportunity to win business and not be the middleman, that I think that they can still leverage those things and they can grow earnings per share. And part of the way that I think they can grow earnings per share is they're going to continue to drive down operating costs. As they scale down facilities and resources that they don't need, they'll be able to bring those operating costs off of line. There's one other part of the story when it comes to the dividend and the cash flows and their ability to support the dividend that's easy to forget, and that's CapEx. So if we look, this is over the past 5 years, CapEx has been all over the place, but large CapEx that we've seen in the past is going to continue to decline, right? So yeah, on a free cash flow per share basis, the math is not favorable, right? When you've been paying $6.54 in dividends over the past year, and you've earned a little over $4 per share in free cash flow, yeah, that's a big delta. But if we look at operating cash flow per share, the math gets a lot more favorable. Operating cash flow, $8.77 versus $6.54 for dividends paid. So that operating cash flow number, again, certainly has come down, but I think we're actually probably approaching the bottom. We're getting to the trough over the next year. And as they bring CapEx down, because they're not going to really need to spend a lot of CapEx over the next couple of years, they're going to be shrinking their asset base and not laying out a lot of new CapEx. I think the math is a little bit more favorable. I think probably the more likely thing is the dividend is going to stay where it is, more likely than being cut, and certainly more likely than being able to grow it. I don't think investors are necessarily likely to make a ton of money on the stock over the next couple of years because they do have to get their operational house in order. But the valuation to me from these prices, if you fast forward 5 years, I think things are really going to be favorable. The tailwinds are still very good for this business. You could say the same thing for FedEx. I think UPS is in a better position. That's another video we can have comparing the two. But again, my bull case is that I think they've turned the corner enough, and we're going to see operating costs continue to come off, CapEx continue to come off, and the cash flows are probably going to be sustainable and even start growing once we get probably 2 years from now.